Silver bounced to $84, vaults 15 days left, oil surges to $90, war has no exit. The jobs report just came in, 92,000 positions gone. Oil crossed $90 for the first time in 2 years. Silver vaults in Shanghai are 15 days from empty. And somewhere in a closed-door meeting today, a central banker looked at these four numbers and said nothing, because there's nothing left to say. The trap has already closed. Welcome to Financial Crisis Explained, the one place where the numbers are never hidden from you. Now, before we go any further, if you haven't subscribed yet, think of it this way. You wouldn't cancel your newspaper after reading only the front page. A wise person always reads every page, every single day. Hit that subscribe button, because what's coming next in this video, you will want to be here for all of it. And tell us in the comments, where in the world are you watching from right now? Whether you're in Karachi, London, Dubai, or New York, we want to know, because this story, it belongs to all of us. There are moments in economic history when a single report changes everything, not gradually, not over months of careful analysis, but in one morning, one number, one direction. February was that morning. The expectation was simple. The United States economy was supposed to add 58,000 jobs in February. That was the forecast. That was what the models predicted. That was what the market had already priced in. Instead, the economy lost 92,000 jobs. Not a miss, not a slight disappointment. A complete reversal of direction. When economists build forecasts, they account for variance. They expect to be wrong by a margin. But a swing of 150,000 jobs, from a projected gain to an actual loss, that is not variance. That is a signal. And the signal did not stop there. Unemployment climbed to 4.4%. The estimate was 4.3%. 1 decimal point. To a casual observer, that sounds insignificant. But in macroeconomics, decimal points move markets. Decimal points change policy decisions. Decimal points tell central bankers that the floor they were standing on is no longer where they thought it was. 4.4% means more people are actively searching for work and not finding it. It means the labor market, which had been the last strong pillar of the American economy, has begun to crack. But here is where the story becomes something far more serious. While jobs were disappearing, wages were not falling. Average hourly earnings rose 4%. Stop. Read that again. Jobs are being lost, and wages are rising. To anyone who has studied economic history, and every serious businessman in this audience should, those two conditions occurring simultaneously have a very specific name. It is not a slowdown. It is not a correction. It is not a soft landing. It is stagflation. Stagflation is the economic condition that breaks conventional policy tools. In a normal recession, the Federal Reserve cuts interest rates. Lower rates encourage borrowing. Borrowing stimulates spending. Spending creates jobs. The economy recovers. That is the standard playbook. But stagflation removes that option entirely. If the Fed cuts rates today, it feeds inflation. Prices rise faster. The cost of living increases. The purchasing power of every dollar held by every American quietly shrinks. If the Fed holds rates where they are, job losses accelerate. Businesses cannot afford to borrow. Expansion stops. Hiring stops. And the unemployment number climbs further past 4.4%. There is no clean move on this board. The Federal Reserve is not managing a crisis. It is sitting inside one, with instruments that were designed for a different kind of problem. The market understood this immediately. Within hours of the jobs report, the S&P 500 dropped over 1%. The NASDAQ fell 1.5%. These are not panic numbers. These are pricing numbers. The market was not reacting emotionally. It was recalculating. It was asking one question. If the Fed cannot cut and cannot hold, what exactly is the policy path forward? And the honest answer that no official will say publicly is that there isn't one, not a clean one, not yet. For the business community watching this, for the entrepreneurs building companies, managing cash flow, making hiring decisions, planning for the next 12 months, this report is not background noise. This is the foundation shifting beneath you. Stagflation means your input costs rise. Your customers have less to spend. Your employees expect wages to keep climbing. And the credit environment that might have helped you bridge the gap is locked behind a Federal Reserve that cannot afford to open that door. This was one report, one morning, one number. But it did not arrive alone, because on the same day the jobs report landed, oil crossed $90, and that changes everything we just discussed, in ways that most analysts are not yet willing to say out loud. Brent at $90, WTI at $80. Energy as the hidden tax. There is a number that governments fear more than unemployment figures, more than inflation data, more than any single economic report. That number is the price of oil. Because oil does not just power vehicles. Oil powers everything. Every product manufactured, every item shipped, every meal cooked in a commercial kitchen, every hospital running on backup generators, every startup paying logistics, costs they never accounted for in their original business plan. Oil is not a commodity. Oil is the circulatory system of the global economy. And today, that system just spiked a fever. Brent crude crossed $90. WTI settled at $87. For context, this is the first time in 2 years that oil has breached this level. 2 years ago, when it last touched $90, inflation was already burning through household budgets worldwide. Central banks were in emergency rate hike mode. Supply chains were still fractured from the pandemic. The world was already fragile, and oil at $90 was one of the accelerants that made everything worse. That was then. Today, the fragility is deeper, the buffers are thinner, and the geopolitical variables surrounding oil are more dangerous than they were in 2022. Then came the number that silenced serious analysts. Qatar issued a warning, not a forecast, not a projection from a financial model, a warning, $150 per barrel, within weeks. Qatar is not an outsider commenting on energy markets. Qatar is one of the most strategically positioned energy-producing nations on the planet. When Qatar speaks about oil pricing, the rooms that matter go quiet. $150 per barrel is not an abstract figure. At $150 oil, airline ticket prices surge 30 to 40%. Freight costs double across major shipping corridors. Agricultural production costs rise sharply. Because fertilizer is petroleum-based, food prices climb, not next quarter, within weeks. Every business model built on stable logistics costs needs to be reopened tonight. But here is what most financial commentary will not explain clearly enough. Oil at $90 and potentially $150 does not just raise prices at the pump. It functions as an invisible tax, one that no government voted on, one that no parliament approved, one that bypasses every fiscal policy tool available to any finance minister in the world. When oil rises, transportation costs rise. When transportation costs rise, every single product in every single supply chain becomes more expensive to move. That cost does not disappear, it transfers directly to the end consumer, the family buying groceries, the small business owner restocking inventory, the entrepreneur importing raw materials for a product they plan to sell at a margin that no longer exists. Now combine this with what Part 1 already established. An economy losing jobs, wages stubbornly rising, a Federal Reserve with no clean policy exit, and now an energy shock entering from the outside. This is not one problem layered on another. This is a compression event, every pressure point activating at the same moment. From the top, monetary policy paralysis. From the bottom, consumer purchasing power eroding. From the outside, an energy price surge acting as accelerant on inflation that was never fully extinguished. The margins that businesses depend on are being squeezed from 3 directions simultaneously. And then there's the war variable. Because $90 oil does not exist in a vacuum. It exists inside a geopolitical environment where the conflict driving energy instability has no visible exit strategy, no ceasefire framework, no negotiated settlement on the horizon, no diplomatic off-ramp that markets can confidently price into their models. War without exit means energy uncertainty without a ceiling. And energy uncertainty without a ceiling means every forecast you made for your business in 2025 may already be obsolete. 2 signals have now landed. A jobs market in structural decline, an energy market breaking upward with no resistance, but neither of these is the most urgent story today, because in Shanghai, a clock is ticking, and it has exactly 15 days left. Shanghai vaults. 15 days from empty, paper versus physical reality. Every major financial crisis in modern history had a warning sign that most people ignored. Not because the sign was hidden, not because the data was unavailable, but because the sign appeared in a market that the majority of investors, analysts, and business decision makers were not watching closely enough. In 2008, it was the mortgage-backed securities market, visible to those paying attention, ignored by almost everyone else. In 2020, it was the repo market, quietly seizing up weeks before the world understood what was happening. Today, the warning sign is in Shanghai, and it has exactly 15 days left. The silver vaults in Shanghai, one of the most critical physical precious metals, storage and delivery infrastructure points in the entire Asian market, are approaching empty, not low, not reduced. 15 days of supply remaining. At current withdrawal rates. In 2 weeks, the physical silver sitting in those vaults will be gone. For the business community watching this, that sentence requires a moment of stillness. Because what happens when a vault runs empty is not simply a supply story, it is a credibility story. And credibility, once broken in commodity markets, does not return quietly. To understand why this matters at a structural level, You must first understand the difference between two versions of silver that exist simultaneously in today's financial system. The first version is paper silver. Paper silver is a contract, a promise, a financial instrument that says somewhere silver exists and you have a claim on it. Traded in enormous volumes daily, priced on exchanges like COMEX in New York, bought and sold by institutions, hedge funds, and algorithmic trading systems that have no intention of ever touching a physical bar of metal. The second version is physical silver. Physical silver is the actual metal. The bar sitting in a vault, the industrial input that solar panel manufacturers need, that electronics producers require, that medical equipment depends on. For decades, these two versions of silver have operated in a fragile but functional relationship. Paper prices set the market rate. Physical supply was assumed to always be available when someone actually needed it. That assumption is now breaking down. COMEX, the primary paper-silver exchange in the United States, is hollowing out in real time. The registered inventory, meaning silver that is actually available for delivery, has been declining steadily, not because demand is falling, because demand is rising and the physical metal is moving out of the financial system and into industrial and private hands, solar energy expansion. Electric vehicle production, defense manufacturing, all of them consume silver, all of them need the physical bar, none of them accept a paper contract in place of an actual delivery. And then there is the investment side of this equation. Silver bounced from $81 to $84 and is holding that level. In technical analysis terms, $81 was a floor test. The market approached that level, looked at the vault data, looked at the COMEX inventory, looked at the industrial demand pipeline, decided that selling silver below $81 in an environment of genuine physical scarcity was not a rational position to hold, so it bounced. $84 is not just a price recovery. $84 is the market beginning to reprice silver against physical reality rather than paper assumptions. The gap between what paper markets say silver is worth and what physical markets know silver is actually worth is widening. And when that gap closes, and in commodity markets it always closes, it does not close gently. Meanwhile, gold is recovering, while equities are selling off, while bond markets are repricing, while the dollar is navigating stagflation signals it was never designed to handle cleanly. Gold is rising. This is not coincidence. This is the flight to safety pattern activating at institutional scale. The money that is leaving equities is not sitting in cash. It is moving into assets that hold value when systems come under pressure. Gold, silver, physical, real. For the entrepreneur, for the business owner, for the young professional building wealth in an environment they were never taught to navigate in any classroom. Silver is not just a trade right now. Silver is a diagnostic tool. When silver vaults run empty, when paper and physical prices diverge, when institutional money accelerates its move toward hard assets, the market is not speculating about a crisis. It is confirming one. 3 signals have now been placed in front of you with complete clarity. A labor market confirming stagflation, an energy market breaking upward with a war providing no exit, a silver market where physical reality is separating from paper fiction. But none of these signals operates independently, because when you place all 3 on the same timeline, on the same week, in the same global economic moment, a 4th and final picture emerges, one that connects every variable, every asset class, every warning, into a single, coherent conclusion that every serious decision maker needs to understand before the market opens again on Monday morning. When oil, silver, jobs, and war move together, it is not coincidence. There's a principle that separates truly strategic thinkers from everyone else in any room. It is not intelligence. It is not access to better data. It is not a more sophisticated financial model. It is the ability to recognize when separate events are not actually separate, when what appears to be 4 different stories, 4 different markets, 4 different problems, is in reality one single coordinated collapse of the assumptions the modern economy was built upon. That moment is now. Let us place every signal on the same table, not one at a time. All of them, simultaneously, the way the market is experiencing them right now. A jobs report confirming that the United States economy lost 92,000 positions in a single month while wages refused to fall. An oil market breaching $90 for the first time in 2 years with Qatar warning $150 is not a worst-case scenario. It is a near-term projection. Silver vaults in Shanghai sitting at 15 days of supply. COMEX paper inventory hollowing out in real time. Physical metal separating from paper pricing in ways the market has not seen at this scale before. And a war with no exit, no framework, no ceiling on its economic consequences. Now ask the question that every serious analyst must eventually ask. When did this start? Because none of these conditions appeared overnight. The stagflation signature was visible in wage data 6 months before this jobs report confirmed it. The oil trajectory was readable in shipping route disruptions, refinery capacity constraints, and geopolitical positioning long before Brent crossed to $90. The silver vault depletion was documented in inventory reports that were publicly available to anyone paying attention. And the war has been telling markets every single day that it has no intention of resolving itself on a timeline that financial models can comfortably accommodate. The data was never hidden. The pattern was always there. What was missing was the willingness to connect it. History has seen this configuration before, not identically. History never repeats with perfect precision, but the architecture, the structural arrangement of these specific pressures converging simultaneously has a precedent. 1973, oil embargo, supply shock, wage pressures refusing to normalize, a Federal Reserve caught between inflation and recession with no clean policy path. The result was a decade of economic stagnation that rewrote the rules of how businesses operated, how governments spent, and how ordinary people built or lost wealth. The investors and business owners who understood what was happening in 1973, not emotionally, not reactively, but structurally, emerged from that decade in a fundamentally different position than those who waited for official confirmation before adjusting their strategy. Official confirmation always arrives late. Always. For the business community watching this, the strategic implications are not abstract. They are operational. They are immediate. They belong on your desk before your next planning meeting. If oil moves toward $150, your logistics costs are not a line item you can manage with minor adjustments. They become a structural threat to your margin architecture. If stagflation deepens, your customers will not simply spend less on luxury items. They will compress spending across categories you assumed were protected. Subscription services, professional development, business tools. All of it gets reviewed when household budgets are under simultaneous pressure from rising prices and falling employment. If silver's physical supply continues separating from paper pricing, and if gold's recovery accelerates as institutional capital continues its quiet migration toward hard assets, then the portfolio assumptions that most young entrepreneurs have never seriously questioned deserve immediate reconsideration. And then there is the war variable, the one that models struggle with most, wars that have no exit. Do not simply create geopolitical instability. They create permanent uncertainty premiums across every connected market: energy, shipping, food supply, currency valuations, defense spending priorities that redirect government budgets away from the infrastructure investments that economies need to grow. A war with no exit is not a background condition. It is an active variable that compounds every other pressure already on this list. Every week it continues. The compression tightens. The trap that Part 1 described as a Federal Reserve problem is not only a Federal Reserve problem, it is a systemic problem. The same trap exists for every business leader trying to plan in an environment where the traditional signals are giving contradictory readings. Equity markets saying one thing, bond markets saying another. Commodity markets sending warnings that neither equities nor bonds have fully priced in yet. The complete picture is never found in any single market. It is found in the connections between them. Jobs to oil, oil to inflation, inflation to Fed paralysis to capital migration to silver and gold to the question every serious person must now ask themselves directly. What does this mean for me? For my business? For my decisions in the next 90 days? Not the next decade. Not some abstract future scenario. The next 90 days. Because that is the window where preparation and reaction produce the most dramatically different outcomes. The people who understood 1973 in January of 1973 did not suffer the decade that followed in the same way as those who understood it in 1979. The data available to both groups was essentially the same. The difference was timing, and the willingness to act on an incomplete picture before it became a complete disaster. 4 signals. 1 week, 1 conclusion. The global economy is not approaching a turning point. It has already turned. But the question is no longer whether these pressures are real. The question is whether you are positioned to navigate what comes next, or whether you are still waiting for someone to officially confirm what the data has already told you.